Friends, thank you for being here today. I want you to sit with a question for just a moment. What if the institution you trust with your life savings, the place where you deposit your paycheck, where you set up your children's education fund, where you take out your mortgage, what if that institution was quietly reaching into your account and taking money that was never theirs to take, not through some shadowy back alley scheme, not through some rogue employee working alone in a basement, but systematically, quietly, through the very fee structures, the very automated systems, the very fine print buried in the terms and conditions you were handed the day you opened your account. That is not a hypothetical. That is not a conspiracy. It is a stated fact released on the record by Canada's own federal regulator. On February 5th, 2026, the Financial Consumer Agency of Canada, the FCAC, confirmed that since 2024, more than $100 million has been forcibly reimbursed to ordinary Canadians. Forcibly, not voluntarily, not out of goodwill. The banks were caught. They were forced to hand the money back. $100 million in what the regulator calls, with clinical precision, market conduct violations. And here is the question that should stop you cold. If these institutions are profitable enough to generate billions, and they are, the big six Canadian banks collectively manage trillions in assets, why are they reaching into the accounts of ordinary people and skimming fees they were never entitled to? Why would an institution that comfortable, that powerful, that entrenched take that risk? The answer, friends, is not incompetence. It is desperation. And once you understand what is driving that desperation, you will never look at your bank statement the same way again. Let me take you back, not to last week's headlines, not to last quarter's earnings call. To understand what is happening right now in the Canadian financial system, we need to go to the foundation, the architecture upon which modern banking was built, and the fault lines that have been quietly spreading through that foundation for decades. The modern commercial bank is not at its core in the business of keeping your money safe. That is the mythology. The reality is something far more elegant and far more dangerous. A bank takes your deposit, pays you a modest return, and then lends that money out at a higher rate. The difference, the spread, is the engine of their profitability. This is not new. This has been the architecture of banking since the founding of the Bank of England in 1694, when the first government bond was issued, and the relationship between sovereign debt and private banking was forged into the bedrock of the financial system. What has changed, what has fundamentally altered the scaffolding of this entire structure, is the interest rate environment of the past 2 decades. When central banks around the world, following the playbook pioneered by Japan in the 1990s, pushed rates towards zero, they handed the banks a gift of almost incomprehensible magnitude. Banks could borrow at virtually nothing. They could lend at something. The spread widened, profits swelled, and the incentive to compete for your business, to actually earn your deposits through service and transparency, evaporated. This is the genesis of the current moment. This is the long causality chain that leads us directly to a regulator in Ottawa announcing a $100 million forced refund and calmly noting that no bank should ever benefit from a negative consumer experience. Because when rates were at zero, the banks did not need to squeeze you. They had the carry trade, they had the spread, they had the architecture of cheap money doing the heavy lifting, but that era is over. The era of zero rates is gone. And what has been left behind is a system that built its profit model on a foundation that no longer exists. scrambling to replace that lost margin anywhere it can find it, including your account. Now, I want to explain to you exactly how this works, because the mechanism is simpler than the banks want you to believe, and the implications are more serious than the regulators want you to understand. Think of the bank's fee structure as scaffolding around a building. When the building is structurally sound, the scaffolding is largely cosmetic. It exists, it generates some revenue, but it is not load-bearing. But when the building itself begins to crack, when the underlying profitability of the institution comes under stress, that scaffolding becomes something else entirely. It becomes a revenue source. It becomes a tool. And the more desperate the institution, the more aggressively it deploys that tool. The FCAC, to its credit, regulates what it calls market conduct: disclosure, fees, complaint handling, fair treatment. It is the watchdog that is supposed to ensure that the relationship between a bank and its customer is honest and transparent. And when the FCAC says that more than $100 million had to be forcibly returned to consumers, it is telling us something that cuts straight through the polished marketing campaigns and the charitable sponsorships and the reassuring television advertisements. It is telling us that the conduct of these institutions, when left to their own devices, is not aligned with the interests of their customers. This leads us to what I call the system's most crucial secret, and we will come to it in detail. But first, let me show you how deep the rot actually runs. The FCAC is not a solvency regulator. That role belongs to OSFI, the Office of the Superintendent of Financial Institutions. And it is critical that you understand this distinction, because it means that what we are seeing from the FCAC is only a partial picture. The FCAC can see the surface, the fee misapplications, the disclosure failures, the complaint handling breakdowns. What it cannot see, or at least what it is not tasked with revealing to you, is what is happening beneath the surface in the balance sheets of these institutions as the economic environment tightens around them. And here is where the picture becomes genuinely alarming. Canadian banks, like all large commercial banks operating in a high-rate environment after years of near-zero rates, are navigating a structural transition that is far more treacherous than their quarterly earnings calls suggest. Loan loss provisions have increased. Credit losses are rising. The mortgage portfolios built during the era of historically cheap borrowing are now repricing into an environment where the monthly payment on the same house has in some cases doubled. Canadians who bought at peak valuations with variable rate mortgages are not abstractions on a spreadsheet. They are your neighbors. They are families making real decisions about food and rent and whether to renew a loan they can no longer comfortably carry. And the banks that issued those mortgages, they are managing the risk, provisioning for it. But the scale of that provisioning is something the public does not fully appreciate, because it is buried in the fine print of documents that are designed to be read by analysts, not by the people whose money is at stake. This is not a conspiracy, friends. It is a structural fault line, and the evidence of the stress is not hidden. It is being announced in measured regulatory language by the very agencies tasked with protecting you. $100 million forcibly returned since 2024. The question is not whether the system is under stress. It is how deep that stress goes and what it means for the money you have placed inside it. Let me now show you the mechanics of exactly how this pressure is spreading, because what the FCAC announcement represents is not an isolated incident of regulatory housekeeping. It is a canary, and the coal mine it is singing in is far larger and far darker than most people realize. You need to understand how market conduct violations actually happen inside a large bank. The FCAC was careful in its February statement to note the technical explanation that large banks process millions of transactions daily, that system coding errors can result in incorrect fee application, that disclosure language updates can lag regulatory expectations. This is technically accurate, and it is also, in the context of what is actually happening, almost entirely beside the point. Here is the reality. When a bank with millions of customers and billions in assets has a coding error that results in fees being incorrectly charged across thousands of accounts, there are two possible explanations. The first is genuine incompetence, a software glitch that no one caught, a disclosure update that fell through the cracks, an automated system running on outdated parameters. The second is something more troubling, a culture of revenue extraction that has become so normalized within the institution that the line between aggressive fee optimization and outright overcharging has become genuinely blurred. And the question you have to ask yourself, friends, is this: in an environment where the net interest margin, the fundamental engine of bank profitability, is being squeezed from multiple directions simultaneously, which explanation is more likely? The vigilantes in the bond market have been at work. When rates rise, and they have risen sharply from the era of near zero that defined the 2010s, the existing bond portfolios held by financial institutions lose value. This is not a metaphor. It is arithmetic. A bond issued when rates were at 1% is worth less when the market rate is 4 or 5%. The institutions that accumulated those bonds, and Canadian banks, like their American and European counterparts, accumulated enormous quantities of them, are sitting on unrealized losses that do not show up in the headlines, but that absolutely show up in the stress calculations of their risk departments. Now layer on top of that the mortgage repricing crisis. Canada's housing market became, during the era of cheap money, a monument to the money illusion. The phenomenon where asset prices inflate in nominal terms, creating the sensation of wealth, while the underlying capacity of ordinary people to service the debt attached to those assets quietly deteriorates. You became a millionaire on paper, but poorer at the grocery store. And now, as those variable rate mortgages reprice, as those fixed terms expire and renew at dramatically higher rates, the stress is becoming visible in the loan loss provisions that the banks are required to disclose. But here is what the banks will not tell you directly. Those provisions are a lagging indicator. By the time the provision appears on the balance sheet, the underlying stress has already been building for months, sometimes years, in the actual behavior of the borrowers, in the missed payments, in the calls to the bank asking for hardship deferrals, in the quiet renegotiations that happen behind closed doors before anything is ever formally classified as a loss. This is the trigger event, not a single dramatic collapse, not a Lehman moment, not a flash crash that makes the evening news. The trigger in the Canadian system is slower, quieter, and in many ways more insidious. It is the gradual repricing of risk across an entire mortgage portfolio built on assumptions that no longer apply. It is the steady accumulation of loan loss provisions that tell you, if you know how to read them, that the institutions are bracing for something. And now let me show you the canaries. The first canary is not a bank. It is a borrower. Specifically, it is the borrower who stretched furthest, who took the largest mortgage relative to their income at the peak of the market on a variable rate, in a city where housing prices had become detached from any reasonable relationship with local incomes. This borrower exists across Canada in enormous numbers. They bought because the price trajectory of Canadian real estate over the past 2 decades made waiting seem like the financially irrational choice. They borrowed because the bank approved them, and the bank approved them because the system's incentive structure rewarded loan volume. That borrower is now in the bank's loan loss provision, not by name, as a statistical cohort, but they are there. The second canary is the fee complaint, and this is where the FCAC data becomes genuinely forensic. When regulatory agencies begin receiving elevated volumes of consumer complaints about fees, about disclosure, about the gap between what was promised and what was charged, it is almost never because the bank suddenly decided to become predatory. It is because the bank's behavior, which was already operating in a gray zone, has begun to drift further into that zone as the financial pressure intensifies. The complaints are the signal. The $100 million remediation is the confirmation. The third canary, and this is the one that should alarm you most, is the regulatory posture itself. The FCAC's commissioner stated publicly that no bank should ever benefit from a negative consumer experience. That is not a neutral bureaucratic statement. That is a regulator who has seen enough of what is happening inside these institutions to feel the need to draw a line in public. Regulators do not issue statements like that when things are fine. They issue statements like that when they are looking at evidence of systemic behavior and trying to change the trajectory before it accelerates. Now let me systematically dismantle the places you might think you can hide. Can you simply leave the bank, move your money somewhere else? In theory, yes. In practice, the alternatives carry their own risks in a tightening environment. Credit unions are not immune to the pressures affecting commercial banks. Their mortgage portfolios face the same repricing dynamics. Their fee structures are subject to the same competitive pressures. The architecture of the problem is not specific to one institution or one type of institution. It is systemic. Can you keep your wealth in stocks? The liquidity is draining. In an environment where central bank balance sheets are tightening, where the era of quantitative easing has given way to quantitative tightening, the marginal dollar that once flowed into equity markets as the only game in town is no longer as abundant. The bid is thinner, the volatility is higher, and the assets that ran furthest on cheap liquidity, the high multiple technology stocks, the speculative growth names, are most vulnerable when that liquidity recedes. This is not speculation. This is the mechanical reality of how risk assets behave when the monetary tide goes out. Can you hold bonds? Yields are spiking, and the inverse relationship between yields and prices means that existing bond positions are underwater. The vigilantes in the bond market are demanding more compensation for the risk of holding sovereign debt in an environment where the fiscal positions of most developed nations have deteriorated sharply. Canada's federal deficit is not a secret. The debt trajectory is not hidden. And the bond market, which is the largest and most sophisticated market on earth, is pricing that reality in real time. Can you hold cash? Inflation continues to erode its purchasing power, even as the headline rate has moderated from its peak. The money illusion works in both directions. When inflation is running above the return on your cash deposits, you are losing real wealth every single day, even if the nominal number in your account stays the same or grows slightly. You feel wealthy. You are getting poorer. The grocery store knows it, even if the bank statement doesn't show it. There is no comfortable corner of the conventional financial system where you can sit and wait this out undisturbed. The liquidity tide is going out, friends, and we are about to find out across the entire system who has been swimming naked. And the FCAC announcement is the first piece of evidence, forensic evidence on the record in regulatory language, that some of the most powerful institutions in Canada have been doing exactly that. Let me give you the full picture of the convergence, because it is not a single force bearing down on the system. It is three distinct pressures arriving simultaneously. And that simultaneity is what makes this moment unlike anything that has come before in the modern Canadian banking era. The first pressure is the mortgage repricing wave. Hundreds of billions of dollars in Canadian mortgages are in the process of renewing at rates dramatically higher than their original terms. This is not a future risk. It is already underway. The banks know it, the borrowers are living it, and the loan loss provisions are the financial system's way of acknowledging, in the only language it uses fluently, that not all of these renewals will go smoothly. The second pressure is the bond market stress. As we discussed, institutions that accumulated fixed income assets during the low-rate era are managing unrealized losses that constrain their balance sheet flexibility. This is not a crisis yet. It is a constraint, but constraints compound. When you have less flexibility to absorb losses, each additional shock, each uptick in loan defaults, each regulatory fine, each remediation payment, carries more weight than it would in a system operating with comfortable buffers. The third pressure is the regulatory tightening itself. The FCAC announcement is not the end of this story. It is the beginning of a more aggressive enforcement posture. The Commissioner's statement was a warning, and warnings of that kind are typically followed by action. What that action looks like: more stringent oversight, higher capital requirements, expanded remediation mandates, will further constrain the operating freedom of institutions that are already navigating a narrowing path. Three forces arriving together on a system that built its profit model on conditions that no longer exist. This is not a market correction. It is not a downturn. It is a structural break, a fault line that has been spreading through the foundation of the Canadian financial architecture for years, and that is now visibly beginning to crack. And here is the crucial question for you personally. Do you understand what this means for the money you have placed inside these institutions? Not in the abstract, not as a macroeconomic observation, but concretely for you, for your savings, your mortgage, your retirement account, your children's education fund. Because this is where we need to talk about something that the financial industry will never discuss with you. They are not equipped to have this conversation. They are not incentivized to have this conversation. And in many cases, they are actively working against your ability to have this conversation with yourself. We need to talk about what happens to your money when the system it lives inside is under structural stress. And we need to talk about it now because the window, as the evidence is making increasingly clear, is not as wide as most people believe. Friends, I want to stop talking about money for a moment. I want to talk about your mind, Because the greatest threat you face right now is not the FCAC announcement. It is not the mortgage repricing wave. It is not the bond market stress or the regulatory tightening or even the quiet desperation that drove Canada's most powerful financial institutions to reach into the accounts of ordinary people and take money that was never theirs. Those are real, those are serious. But they are external forces, and external forces, once you understand them, can be navigated. The greatest threat is internal. It is sitting between your ears right now, and it has a name. It is called normalcy bias. Human beings are hardwired, genuinely hardwired at a neurological level, to believe that tomorrow will look like yesterday. This is not a character flaw. It is an evolutionary adaptation. For most of human history, tomorrow did look like yesterday. The seasons were predictable, the threats were familiar, the strategies that worked last year worked this year. The brain learned to extrapolate from the recent past and treat that extrapolation as reality. But the financial system is not a season. It is not a predictable natural cycle. It is a human construction built on confidence, on convention, on the collective agreement that the numbers on a screen represent something real and stable. And when that construction begins to crack, the normalcy bias does not update. It doubles down. It finds reasons why this time is different. It tells you that the institutions are too big to fail, that the regulators will catch it, that what happened in 2008 cannot happen here in Canada in 2026 to you. And that is exactly what it told the people who lost the most in every financial crisis that has ever occurred. I want to be precise about what I mean. I am not telling you that the Canadian banking system is on the verge of collapse tomorrow morning. I am telling you something more nuanced and in many ways more important. I am telling you that the architecture of the system has changed, that the conditions which made it safe to assume stability no longer fully apply, and that the cost of not updating your assumptions is being measured right now in the accounts of the Canadians who trusted that their bank would never take money it wasn't owed, $100 million since 2024, forcibly returned. That is not stability. That is a system under stress, expressing that stress through the behavior of its most powerful actors. Now, let me bring you to the second psychological trap, because normalcy bias is not the only cognitive enemy you are facing. There is something else, something the financial industry has perfected over decades of marketing, and it is called the money illusion. The money illusion is elegant in its simplicity and devastating in its consequences. It works like this. You look at your bank statement. The number is higher than it was 5 years ago. Your portfolio, if you have one, has grown. Your home, if you own one, is worth more in nominal terms than what you paid for it. Everything appears to be moving in the right direction. You feel, in the most fundamental sense, wealthier. But strip away the nominal numbers and look at what those numbers actually buy. Look at what a trip to the grocery store costs compared to 3 years ago. Look at what your insurance premium is doing. Look at what it costs to fill a tank of gas, to pay for a plumber, to send a child to university. The purchasing power of the wealth you are accumulating on paper is not keeping pace with the real cost of the life you are trying to live. You are becoming a millionaire on paper, friends, and you are getting poorer at the grocery store. This is the money illusion, and it is not accidental. A financial system that benefits from your continued participation, from your continued deposits, your continued mortgage payments, your continued investment in financial products that generate fees for the institutions managing them, has every incentive to maintain this illusion for as long as possible. The moment you see through it is the moment you become a problem for the system rather than a source of profit. And this brings us finally to the only question that actually matters for you personally, not as a macroeconomic observer, not as someone intellectually curious about financial architecture, as a person with real money, real obligations, real goals, and a finite window of time in which to protect what you have built. The question is this: do you own assets or do you own claims on assets? This distinction is the most important financial concept that the mainstream financial industry will never explain to you clearly, because the answer to that question determines whose interests are being served by your financial decisions. A stock is a claim on an asset. It is a legal instrument that represents a share of ownership in a company, but that share of ownership is mediated through a system, brokers, custodians, clearinghouses, exchanges, that sits between you and the underlying reality of the business. In normal times, that mediation is invisible and harmless. In stress times, it becomes load-bearing in ways that most retail investors do not fully appreciate until it is too late. A bond is a claim on a future cash flow. A bank deposit is a claim on the bank's balance sheet. You are, in the most technical legal sense, an unsecured creditor of the institution holding your money. If you have not thought about that sentence before, I want you to sit with it for a moment. Your savings account is you lending money to the bank. The bank's obligation to repay you is governed by the same regulatory framework that just forced $100 million remediation for conduct violations. Now contrast those claims with an asset: physical gold, physical silver, land, productive property, things that exist in the material world, that do not require a counterparty to honor an obligation, that do not evaporate when a clearinghouse freezes, that do not get repriced to zero when a credit line is withdrawn. There is a company, let me give you a specific example, because I believe in forensic evidence rather than abstract argument, called Tricolor Auto Group, a subprime auto lender. When credit conditions tightened, when the liquidity that had been propping up the subprime lending market began to drain, Tricolor's credit lines froze. Not because the company made one catastrophic decision, because the system that it depended on, the system of cheap credit and abundant liquidity, underwent a structural change, and Tricolor was not equipped to survive that change. The company that looked perfectly viable in one monetary environment imploded in another. Your claim on a financial asset is only as good as the environment that supports it, and the environment, friends, is changing. This is not an argument for panic. I want to be absolutely clear about that. Panic is what the normalcy bias produces when it finally breaks, the sudden violent swing from everything is fine to nothing can be saved. That swing destroys wealth just as surely as the crisis itself, because it causes people to make decisions at the worst possible moment, at peak fear, when the rational calculation has been completely overridden by the psychological collapse. What I am arguing for is the opposite of panic. I am arguing for deliberate, informed, calm repositioning, the movement of a portion of your wealth, not all of it, but a meaningful portion, from claims on assets to assets themselves, from paper wealth to hard wealth, from the financial system's promises to things that exist, regardless of whether those promises are honored. The case for gold and silver in this environment is not sentimental. It is not about some nostalgic attachment to a pre-digital monetary system. It is structural. Gold has no counterparty risk. It cannot be debased by a central bank decision. It cannot be seized by a fee structure run on automated systems that no regulator was watching closely enough. It has functioned as a store of value across thousands of years and dozens of monetary systems, including every single one that has ever reached its mathematical endgame and been forced to reset. The question is not whether gold is a perfect asset. No asset is perfect. The question is whether, in a moment when the architecture of the financial system is under visible and documented stress, when a federal regulator is announcing forced remediations, when mortgage portfolios are repricing into an environment their original underwriting did not contemplate, when the bond market vigilantes are demanding higher compensation for risks that were previously ignored, whether the balance of your wealth should be tilted slightly more toward things that exist in the physical world and slightly less toward claims that depend on institutional health and systemic stability. Stepping into hard assets at this moment is not making a bet. It is stepping out of the line of fire. Let me also speak plainly about what you should be watching for, because the indicators are already visible if you know where to look. Watch the loan loss provisions in the next 2 quarterly earnings cycles from the Big Six. Watch whether they continue to increase and by how much. Watch the FCAC's enforcement actions, specifically whether the February announcement is followed by further named violations, higher penalties, or expanded remediation mandates. Watch the spread between what Canadian banks are paying for deposit funding and what they are charging for loans. If that spread narrows further, the pressure on their revenue model intensifies, and the behavioral incentive to extract fees from existing customers grows. These are not obscure indicators available only to institutional analysts. They are public. They are disclosed. They are the financial system's way of communicating in regulated language what is actually happening inside it. You simply have to choose to read them, and you have to choose to read them now, because the most important characteristic of structural transitions in financial systems is that they are invisible until they are not. The crack in the foundation does not announce itself. The scaffolding does not send a warning. What happens is that the system functions and functions and functions until one day the load exceeds the capacity, and what looked like stability was actually a sustained imbalance that had been accumulating for years. We are in that accumulation phase right now. The FCAC announcement is a data point. The loan loss provisions are a data point. The mortgage repricing wave is a data point. The regulatory tightening is a data point. Each individual data point has a benign technical explanation. In aggregate, they describe a system that is under more stress than its public communications acknowledge, managed by institutions whose behavior, when the pressure gets high enough, has already demonstrated a willingness to reach into the accounts of the people who trusted them most. Human beings have a remarkable capacity to adapt, to protect what matters, to make smart decisions in advance of a crisis rather than in the middle of one. But that capacity requires information. It requires the willingness to look clearly at what the evidence is showing, rather than retreating into the comfortable certainty of the normalcy bias. The window for clear-eyed preparation is not infinite. It is not closing at some abstract future date that you can defer indefinitely while waiting for more convenient circumstances. It is closing now in real time with each rate renewal, each regulatory announcement, each quarterly provision, each $100 million remediation that confirms what the system's own data has been signaling for months. There is a reason that the commissioner of the FCAC felt the need to stand in front of a microphone in February of 2026 and say, on the record, that no bank should ever benefit from a negative consumer experience. That statement is not reassurance. It is a warning dressed in the careful language of regulatory propriety, and it deserves to be heard for what it is. The banks will tell you that $100 million is small relative to their total assets. They are right. It is. But the question is not the size of the remediation. The question is what the need for that remediation reveals about the internal culture and the financial pressure of the institutions managing your wealth. Small cracks in large buildings are not reassuring because the building is large. They are alarming because the crack is there at all. Protect your foundation, friends, not because the edifice is guaranteed to crumble, but because the cost of protecting it, if you are wrong about the risk, is modest, and the cost of ignoring it, if you are right, is everything. The great financial transitions of history do not announce themselves with fanfare. They arrive quietly through a series of small confirming signals that, in retrospect, seem obvious. A regulatory announcement here, a provision increase there, a fee complaint that grows into $100 million remediation, and then, one day, something that looks like a single event but is actually the final expression of a structural imbalance that had been building for years. History favors the prepared, friends, and the window for preparation is closing. The assets that will hold their value through what is coming are not the ones that exist as entries in a bank's ledger system, subject to the same automated coding errors that produce the violations the FCAC just spent 2 years remediating. They are the ones that exist in the world, tangible, real, beyond the reach of the fee structure, the disclosure failure, the conduct violation, the regulatory fine. This is the transition from illusion to reality, from paper wealth to hard wealth, from the comfort of the normalcy bias to the clarity of preparation. It begins with a decision, the decision to take what the evidence is showing seriously before the moment when everyone else is finally forced to take it seriously, when the crack has become a collapse, when the scaffolding has come down, when the options that are available to you today have vanished. That decision is yours, but the window to make it wisely, calmly, and on your own terms, rather than in the chaos of a market that has finally caught up to what the data has been signaling all along. That window is open right now. Make use of it.